Today, we've got a continuing topic as we talk about working capital, and we're going to talk about why buyers need extra cash after closing. And we'll see that why working capital is that hidden cash need. And that hidden cash need typically hits about day 60 or day 90, day 75 after the transaction, when the owner of the business is not worrying about the price they paid, probably worrying about where's my cash. And if we remember the story, I've got profit, but where's my cash? They've got great customers. They've got great vendors who they can purchase inventory. And so they buy the inventory, they sell it, and they go, great, I've got profit, but I don't have any cash, because they've got a buildup in accounts receivables, right? So I've got profit, but where's my cash? At day 60, day 75, day 90, that starts showing up big time. They won't worry about the price they paid for the business, but they'll worry about where's my cash. That's the number one reason why business fails, is because they're undercapitalized. It's not based on the purchase price. It's based on, do they have enough cash to operate the business after they've purchased that? Remember that intangible assets are typically defined as the purchase price minus the tangible assets, FF&E and inventory, things like that. Everything else is intangible. And frequently that intangible asset may be the reputation, the accounts receivables, the phone numbers, and it may include, typically does, a covenant not to compete. And so those are the things that will make up that intangible asset. Sometimes we call that goodwill, right? All right, so we've bought all those assets, but now we need the cash to turn those. So we need some working capital, and we need cash so that we can fund that operating cycle and that flow of inventory comes in, sale is made, accounts receivables are collected later on in the period. And it is that cycle that we need to make sure a buyer has enough cash to fund. All right, so that's the idea. It's the hidden cash need in the asset sale. Why buyers need extra working capital after closing? Well, it's because most small business asset sales, the seller keeps the cash and it keeps the accounts receivable. Why is that true? Because those two items are not included in the market multiples that we use. There may be some market multiples where inventory is included, but it tends to be very opaque and not clear. Okay, so cash and accounts receivables are typically not included as a cash-free, debt-free deal, right? Okay, so the buyer starts off with zero in accounts receivable, hasn't sold anything yet, and must replace the sold inventory to keep operating. They've sold the inventory, it's not available for sale, I've got to replace that inventory. So that need is, my accounts receivables are going to start building up, and I'm going to have to replace inventory, and that's the operating cycle that we have to fund. The result is that a buyer must inject extra cash, we'll call that the working capital, post-closing to bridge the gap until the cash flows come in. In a few weeks or months, we'll start talking about the cash budget. And the cash budget will identify that plug figure where external financing is needed, meaning that we don't have enough cash generated by the business during this build-up period, and so we must inject external capital outside of the company. And there's two forces that drain cash. It's the accounts receivable buildup and the inventory replacement. So there are two forces that drain cash. One is that accounts receivable buildup. A new credit sale immediately creates an account receivable. Now remember that there's another force that hides this cash need, and that's called cash accounting. So you may have a tax return or a financial statement that is based on a cash accounting method, which simply says I have revenue when I receive cash and I have expense when cash goes out. So accounts receivables and accounts payables are typically not showing on a cash accounting statement, whether that's a company prepared statement or the tax return. So I've had to deliver my product and service, but cash doesn't arrive for 30 or 60 days later, and I must fund that days sales outstanding. That's the difference between the accounts receivable turnover, which is related to sales and accounts receivable. The second force that drives the cash drain is the inventory replacement. So we buy the seller's inventory at closing. Remember that in the peer comps multiple, FF&E and inventory are included. Sometimes we have to look and say, is there excess inventory, investment inventory, more than average inventory? But let's say you buy the seller's existing inventory at closing, but as soon as it sells, it's gone, and the owner must replace that inventory to stay in business, and typically can't wait until they receive the cash to make that purchase, because then they've got a stock out, right? They have inventory, it's sold, can't be sold to anybody else. I can't wait until I get paid and then order inventory over here. No, inventory goes out and I need to immediately replace that so that I can generate a sale. So we must fund the day's inventory outstanding also. And we abbreviate that by DIO, that inventory amount divided by 365, divided by that inventory amount, and that tells me, okay, I have 18 days, and that gives me my turnover. I turn it over 4 times or 5 times or 10 times. If I turned it over 10 times, then my days inventory outstanding is 36. Those are the two big forces that drain cash. The extra working capital needed is approximately that full operating cycle. And this is a conservative approach because we're just looking at inventory plus accounts receivables or days sales outstanding. We haven't received any credit yet or lag in cash going out from our accounts payables outstanding. But that assumes that the creation of an accounts payable assumes that the new buyer is immediately going to be purchasing from the same vendors as the former owner did. And there may be a little bit of delay there. New guarantors, there may need to be some new credit limits or credit check. There may need to be some account approval. So some work there is needed because there may be a delay in the new owner being able to buy inventory in the same manner that the former owner did. It may not be an issue, but if it is, it becomes a problem. So to be conservative, let's just look at funding the operating cycle, not that full cash conversion cycle. The operating cycle is the accounts receivable, and here we have our days outstanding, and we can multiply by that daily cash outflow that gives us this amount of cash. We add to it this inventory replacement. How much inventory do I have on hand? We'll say 35 days worth of inventory. Well, that creates $70,000 in cash need. So the extra cash closing in this example is $220,000. Now, we may be able to fund that in a line of credit, but the whole idea is not to be caught short in the first 60 to 90 days. Okay, so here we've got an HVAC company. And here's our income statement. We can see the profit that they have. Well, that profit and those cash flows are based on the assets that this company holds also. And you can see that they hold about $80,000 in cash, but they also hold about $130,000 or $140,000 in accounts receivables and inventory. 115 plus 22, $137,000. So they have that investment, and you can see that 95 to 115, this 20 to 22,000, that's pretty stable. Now remember that this is at the end of the year, and because we have only year-end statements, we don't really know what happens in the middle of the year at the peak selling season. There may be higher amounts of accounts receivable. There may be higher amounts of inventory that are needed, and we'll need to take that in consideration also, and we can do that in BizPro Value. The ability to sell on credit creates revenue. Those are useful assets that create revenue, that create profit. Drain these assets, and my revenue and profits probably drain also. So in this first year, our goal for the new buyer is simply to replicate the seller prior owner did. Okay, let's look at our seasonal working capital module here. And now we've said that if my annual sales was evenly divided, 8.3, 8.3, 100% divided by 12 is 8.33%, right? Well, then that would tell me that I need this same $48,000 for every month. Well, this may not be true. For example, let's say that the beginning of the year starts in January. And let's say we sell more things as the year goes on, and the summer months are my key months of selling. Let's make that a little bit smaller so we can see all the years, and we've got 7 and 4%. Okay, now we have some seasonality in our sales so that our daily cash outflow may vary. Now it says that my working capital need may be $62,000 based on the seasonality of sales. So it says that when sales are low, my working capital need is low. I don't have as much accounts receivables. But in my busy months when I'm selling a lot, I do have more accounts receivables and I need more working capital. Here we have $62,000, as you can see here, and you can see graphically that shown. On average, we needed 48, but with seasonality factored in, we need $62,000 worth of working capital at a high point. So those things factor into the amount of working capital that we're going to include. We know that in the asset sale, they have bought these net fixed assets. It is with certainty and knowledge and transparency that we see in BizPro Value that helps crack the code and solve that hidden cash need in the asset sale of the small business. I hope this is both understandable and sinks into, because it's such an important thing to maintain good buyer relationships as that 60th, 75th, and 90th day start approaching, and that customer may be feeling that cash squeeze. But because you have funded the deal with a suitable amount of working capital, everybody has a lot more less stress and a lot more happiness to it. So it's all about succeeding in this business in the long term. Understanding working capital is a huge part of that. Thanks so much for joining us here today. We'll see you next week.